here any kind of misstatements, errors or frauds in the material information. Three types of risk basically. This includes inherent risk, control risk and detection risk. So here checking the processes, so how it is done. So basically how the transaction is recorded, or seeking for the vouchers and evidences for that particular transactions. Hello everyone, I am Nikhilavati S, Faculty of Commerce, Vidhyaashram First Grade College, the Temple of Excellence, MYSURU. I welcome you all for the first session of the Unit 2 of the subject Principles and Practice of Auditing. So, in this session, we will be starting with Unit 2, that is Risk Assessment and Internal Control. As we all know, auditing is all about systematic examination of books of accounts. And risk assessment and internal control are the backbone of auditing process, which ensures that or makes us realize that auditing or the company's financial health is not just about a good fortune but of robust system and proper planning. So in this session, let us learn what is risk assessment and internal control is all about. We'll also know what is audit risk. So, risk assessment. Risk assessment is the process of identifying, analyzing and evaluating the various risks that could potentially impact an organization's financial statements. So, risk assessment is a process which involves identifying, analyzing as well as evaluating the areas of risk and those risks which has impact on the organization's financial statements. It involves understanding the company, its environment and its internal controls, and to identify those areas where there might be high risk of material misstatement. That means here any kind of misstatements, errors or frauds in the material information. So those financial information which is relevant, which has some impact on the financial position of the organization is material information. So identifying of those risks which have high risk of material misstatement, and this could be due to errors, fraud and other reasons. So the reasons why there may be risk is caused due to the various kinds of errors, frauds and other reasons. Now let us know the meaning of internal control. So internal control refers to the policies, procedures and processes put in place by an organization to ensure the integrity of financial and accounting information. So basically the various management functions include planning, organizing, staffing, coordinating, controlling, etc. So controlling is one of the main function of the management. So in every business organization, there will be a management having internal control which takes care of all the activities in the organization. So it involves the various policies, procedures and processes that are formed by an organization in order to ensure the integrity of financial and accounting information and also to promote accountability. So accountability basically means the ability or to be responsible for what we have done. So it promotes accountability and prevent fraud. So basically the internal control system in the organization helps us to promote accountability and to bring integrity of financial information and to reduce frauds. Then internal controls, these are designed to provide reasonable assurance that a company's operations are effective and efficiency. Then the financial reporting is reliable, laws and regulations are complied with. So a proper internal control system in the organization helps us to ensure that whatever the company is operating is effective and efficient, as well as the financial reporting is reliable. So why risk assessment and internal control is important in auditing? Let us take one example. Say for example, there is a retail business named Shop Zone. So this Shop Zone company has both a physical store as well as it is handling a online shop. And now the Shop Zone's management is worried because of its inventory management and the discrepancies found in their inventory management. As as per their experience in the past, they found that say for example, the inventory records that were shown in the physical records and the inventory records that were shown in the online records were different. Now, the auditor, what he'll do means, he'll conduct a risk assessment of the inventory management system in the Shop Zone company. During an audit, the auditor conducts a risk assessment about the inventory management system that is followed in the Shop Zone company, both in the physical store as well as in the online platform. And they discovered that there are no standardized process in order to enter or the log all the inventory levels properly in their physical store. So this indicates that here the problem is with the internal control system, that it is not having a standardized process to record all the inventory. That's why there were difference in the inventory management. So by auditing, we can find out that what are the risk areas that could impact the financial statements of a business. So risk assessment and internal control are the fundamental aspects of auditing process. These are not just about ticking the boxes and checking that whether there is risk or not, but these are about ensuring that the organization's financial statements are reliable, the organization's operations are reliable. So basically, the audit risk is a fundamental concept in auditing that represents the possibility that an auditor may unknowingly issue an incorrect audit opinion on the financial statements that are materially misstated. That means audit risk comes when an auditor gives an opinion that is not actually what is depicted in the financial statement. Say for example, he has given an opinion that the company's financial statements are true and fair, but it was, found that there were material misstatements in the financial statements. So that is audit risk. So understanding and managing audit risk is crucial for auditors because it directly impacts the reliability of their work. So the basic or the important objective of all the auditing process is that to ensure the reliability of the financial statements. But if this audit risk occurs, there is no meaning in the audit work that is done. So it is important to ensure that the audit risk is minimized and also the trust of stakeholders place in their reports. So audit risk is that risk where the auditor gives an inappropriate opinion where actually the material misstatements are happened. So the audit risk is composed of three types of risk basically. This includes inherent risk, control risk and detection risk. So to discuss one by one, so inherent risk, as the name itself indicates, inherent risk means here the risk arises as an inheritance based on the nature of the business, or it comes along with the type of the products and services that the company is producing. Say for example, if the company is dealing with complex financial statements or derivatives, there are chances that the risks are happening in the risk may happen in the area of the financial statements. So it is inherent to the business. It is based on the nature of the business. There are risks that are arising. Say for example, if the company is dealing in complex financial transactions, so there are chances that the frauds and errors may be present in the financial transactions. So next we have is controlled risk. So here also, as the name itself indicates, these are the risks which can be controlled by the internal control system of the organization. But these here the risk arise due to lack of proper control from the side of the management in the business. So if the company is not having strong internal control system in the organization, there are chances that there may be control risks that may arise in the financial statements. Then we have detection risk. So here the risk is arise due to if the auditor fails to detect a mistake. Just now we discussed it's the audit risk, where the auditor fails to detect any kind of risk and gives a false opinion or an inappropriate opinion. So this is from the side of the auditor. So that is why it is called as detection risk, where the auditor has failed to detect a risk. So any risk that may arise due to lack of detection from the side of the auditor. Next, let us discuss about the methods and techniques auditors use to evaluate risk. So when the auditors goes for the auditing process, in order to evaluate or identify the risk areas, they may use certain methods and techniques. So these may include where it is like a detective and asking questions and seeking the solutions, or by asking questions, digging out the truth, etc. So the auditors, in order to gather information, they may use certain methods including inquiry, observation, inspection, etc. So here coming to the inquiry. So here the auditors goes for inquiring about some information or regarding some transaction. So he may inquire or ask questions in order to seek information from all the stakeholders, employees, or the management of the business. So this helps the auditors in order to gather insights about how the business operates and what are the potential areas of risk or what are the risks involved. For example, the auditor may ask the company's management regarding how the revenue is recognized in that particular company or a business organization. He'll come to know that how the revenue is recognized for a complex transaction or a contract. So based on that, he can analyze whether the more risk is involved here or not. So if in case, he can decide whether to give more time for it or not. So next is observation. So the observation means watching how the certain procedures or the process takes place in the organization. So here the auditor may observe certain transactions, how it is happening, how the companies. For example, the auditor may observe how the cash counting procedure is done in that particular retail store or a company. So he may observe himself like how it is counted and what are the procedures followed. And he may also ascertain by observing various practices and procedures that are happening in the business organization. So next is inspection. So here checking the processes. So how it is done. So basically how the transaction is recorded, or seeking for the vouchers and evidences for that particular transactions, etc. This can include inspecting the bank statements, vouchers and various contract papers, documents, etc. For example, the auditor may inspect for the purchase vouchers as well as the sales transactions and the transactions with the suppliers. And if he finds that any discrepancies are found, it indicates that this is an area of the risk. So it indicates a risk of misstated expenses. So this is how the auditor can identify the various risks that may arise. And next is analytical procedure. So analytical procedure involves various, it involves the financial data analysis by the auditor to see like whether, checking the patterns or the trends of that particular expense or income, or the trends of profit or the sales, how it is moving. Through that also, he can identify whether there are, risks are found there or not. For example, an auditor may compare the sales report of this particular year with the previous year, and if he identifies any changes, or if he finds that there is a dramatic increase in the sales, or there are no cash flows or cash inflows, so this indicates that there is a potential risk in the transactions records. So next we have is reperformance. So here, as it says reperformance, here the auditors go for performing once again, like calculating the procedures and the steps, or the transactions, or the calculation of depreciation, etc. So he himself goes for reperforming it. So he himself goes for recalculating it, then identifies whether there are risks in that particular transactions or the area or not. Then the auditor may go for confirmation. So the auditor get confirmation by communicating with external or the third parties. These may include various stakeholders like the banks or other financial institutions, the clients or the customers, etc. So a walkthrough involves following a transaction from start to finish and trying to understand the entire process and control in place. So this helps the auditor to understand where the mistake is happening or where the errors or frauds may occur. So this helps the auditors to identify the potential weaknesses in the process that is followed by the internal control system in the company. So as we can understand, risk assessment and internal control are like laying the foundation for a successful audit. Identifying the risk helps the auditors to give time wherever required, so that they can concentrate more on the needed and areas where there are there is scope for frauds and errors to happen. This helps the auditors to conduct a successful audit. So this was all regarding the audit risk and the methods that are used by the auditors in order to perform or analyze the risk. Hope you all have understood. Thank you.